Hello everyone, and welcome to this edition of the NZX Virtual Investor Event. My name is Oliver Logan. I'm one of the relationship managers here at the Exchange, and we'll be hosting today's session. Today we've got speakers from four different listed issuers. First up, we'll have Justin McCarthy, who's GM of Investor Relations at Westpac. He'll be followed by Dr. Hart Atkinson and Malcolm Tovey from AFT Pharmaceuticals. Peter Mentz will then follow. He's CEO of Argosy Property. And finally, we'll have Jeremy Nicol, who's CEO of Arvida Group. Just a reminder for those who haven't remembered around the format, each presentation will be about 15 minutes, give or take, followed by Q&A from the floor. So we really do encourage everyone to send through the questions that you may have for each speaker, and we will try and address all of those in the Q&A. Anything we can't, we will get through to them afterwards and provide an answer on. And just a reminder, the recording will be available afterwards on YouTube as well if you want to have a look back through anything at all. So we can kick into it. First up, we've got Justin. So welcome, Justin. Justin's GM of Investor Relations at Westpac Group, having relatively recently joined there. Justin's got a background across sort of financial services, an analyst in investor relation roles, and as a CFA child holder, so has really kind of deep experience across capital markets and banking, and is joining us from Sydney. So welcome, Justin. I'll hand over to you for the next 10 to 15 minutes.
Thanks a lot, Oliver, and good morning, everyone. We really appreciate the opportunity to present and talk with you today. I thought I might just start off with a very high level, quick history lesson on Westpac. We're the oldest bank in Australia, so we're founded all the way back in 1817. We're number 2 in market share in Australia in the large consumer banking area behind CBA, with a mortgage market share above 20% and deposit share similarly. We've spent the last few years simplifying the group back to sort of core banking, as most of the banks have, contracting back to the main business lines of consumer, and for us to a lesser extent, business and institutional banking. We've got a pretty highly engaged employee base at the moment, which is great, despite being through a fairly tough time with our measure of organisation health, sort of three percentage points above the global median. Very strong balance sheet, which is where we want to be. The Australasian banking industry is in a very good spot. Wasn't long ago that we had those regional banking issues where everyone was really worried about balance sheet and liquidity. Those sort of days have been forgotten fairly quickly as well, but they might come back. So very highly rated, capital levels up, towards in the top 5 essentially across the global banks. Almost 13 million customers across a multi-brand strategy. The main brand is clearly the Westpac brand, or Westpac New Zealand for you folk across the ditch, as we say. And we've got some regional brands as well, the main one of which is St George. That's sort of a bit of a high level background on us as an entity. In terms of the current year we're in, we're sort of 2 months now through in the second half of FY23 for us. We have a 30 September financial year. Reported our results, first half results, back in May. And it was a pretty good half for us after a tough few years, where we're now far more focused on the customer proposition and looking forward after going through a pretty tough period on our core program and fixing up some of our internal operational risk management practices. We've always been really strong on credit risk. We made further progress in simplifying the bank. As I mentioned, a really strong balance sheet. And now we've done a lot of that heavy lifting, we feel like we're in a much stronger position to move into our next strategic phase. And our CEO, Peter King, and CFO discussed that in a little bit more detail for the first time at our half-year results, where we've moved from away the old strategy of fix, simplify, perform, which is more about looking internally and sorting our, getting our own house in order, to far more of an external view, where it's about a customer-facing, improving our customer proposition, and we feel like we're making pretty good headway on that. So it was a pretty good half for us. Sorry, I've gone the wrong way here. And that was reflected in half-year results. So a few tough years and returns looking much better in the period, which is really encouraging. And for us, simply the way we're looking at the bank now in terms of measuring ourselves is pretty simple. What's our market position in our various business lines? Sometimes that might be measured in terms of market share. Other times it might be measured in terms of customer rankings or leaderboards, etc. And then what's important for you guys as shareholders is when and how does that translate into returns? We feel like we're on the up, and it was a really good half for us. So the main return metric that we look at is return on tangible equity, and we saw a significant improvement in the half. So we're back in double digits. The return was up almost or more than 350 basis points in the half to 12.8%. And that's from a low back in FY20 where we went through that tough period, subsequently through that COVID period. And so now we've got returns back above our cost of capital, which suggests to us that we're now creating decent economic value for shareholders. Encouragingly, that higher return meant that the earnings per share growth was pretty good. So earnings per share growth in the half was up 26%. That was stronger than the profit growth because we're still getting some of the benefit from the share buyback and the averaging impact of that share buyback that finished in the FY22 year. And those stronger earnings meant that we could pay higher dividends. So the dividend in the period of 70 cents per share was pretty strong growth in the period. In terms of moving to that balance sheet, and this was really important for us, and throughout the course of probably the last 18 months, 2 years, we've been really cognizant that the environment's probably going to get tougher, not easier, and that prioritising a really strong balance sheet was really important for the bank, especially given what we've seen in some of those offshore jurisdictions with some of the financial systems and banking systems, in particular the US regional banks getting into a little bit of trouble. And we're a long way from where the Australian banks, and us in particular, were back in the pre-GFC period. So in terms of our capital levels, really strong capital. And Peter King, our CFO, emphasised that at the half, that in his 30 years at the bank, he's never seen the bank in a stronger financial position. So that puts us in really good stead for what looks like a pretty tough period over the next 12 to 18 months. Although encouragingly, we're now seeing more and more evidence of this idea of a soft landing, where central banks everywhere seem to be almost engineering the soft landing. We'll wait and see. We remain pretty cautious, and our outlook is for pretty anemic economic growth, both here in Australia and across your way in New Zealand. Capital looking really good, so 12.3%, and that means that we've got more than $3.5 billion of, in some ways, excess capital or capital above the top end of our target range, which means provides plenty of scope for us to absorb a tougher economic environment, grow more and deploy some of that capital, or if conditions remain benign, potentially hand some of that capital back. And we certainly had quite a few questions post the half-year results about when and if there is potential for a buyback. We feel it's a little bit early to call that. In terms of our provisioning levels, again, reflective of a very strong balance sheet, where our base case economic scenario suggests that our expected credit losses will be about $3.5 billion, yet we're carrying almost $5 billion of provisions. So again, really well placed for that. So if conditions remain benign, you're likely to see fairly low BDD charges, although we expect a bit of an uptick, but we're really well positioned for that to come. Liquidity is much, much stronger than than what it was 5, 10, 15 years ago. And typically this is where banks get into trouble. So if you think of the US regional banks that got into a bit of trouble, a liquidity issue then becomes a solvency issue. And we're carrying a lot of liquids. So the metric and ratios called the liquidity coverage ratio. And for us, it's up near that 140% mark, which is really strong. And liquid assets as a proportion of total assets for us are above 20%. And if you think back in March 2008, pre-GFC, that was below 10%. So a much stronger liquidity position, which means we can absorb some dislocation in markets. In terms of funding, again, a much stronger funding position than we've seen before. So again, if we go back all the way to pre-GFC days, we used to have a lot more short-term wholesale funding. If you fast forward to today, we've got a lot more customer deposits as a proportion of our funding book than we did back then. And within our wholesale funding program, we've got a lot more long-term wholesale debt than short-term wholesale debt. We want to maintain those pretty strong balance sheet settings going forward, and we think we're pretty well placed to continue to do that. In terms of us becoming a much simpler, stronger bank, we've made really good progress on that. So we've exited 9 businesses. So the wealth businesses have largely gone. We still have our platforms business, which is BT Panorama is the branding for that. And we announced a couple of weeks ago that we were looking to sell that over the last couple of years, but we're going to keep that. So that's the one business we are going to keep. But we've exited essentially 9 to 10 businesses over the last couple of years. So we're a much simpler bank, and we've made really good progress on that. We've made good progress on our building up what we call our stronger foundations with our core program, which is really about embedding an improved risk management from an operational risk side across the bank. So the next issue that arises will be far better positioned for that. We've also made a lot of progress on right-sizing our footprint, both from an office space perspective and getting the retail footprint right. Far more of our customers, as you'd be aware, want to deal with us digitally. So we're collapsing a lot of our branches into co-locations. So it doesn't matter what brand you bank with, you can come in and bank with us. And we've rationalised some of our footprint as well. And we've made really good progress, we feel, on digitising the bank and removing some of the complexity. There's still quite a long way to go on that, but we've made really good progress. And for us, more broadly, compared to some of our peers, the IT architecture and infrastructure requires some more investment over the coming years. And as we've made progress on our risk and regulation programs that will start to come off, that will free up some resources and capacity for us to continue to make improvements there, and that should help our operational efficiency as we go forward. In terms of all that progress we've made, so we've tweaked, as I mentioned earlier, we've tweaked our strategy. Now it's more about growth and return. And as I mentioned, the 2 key metrics at the end of the day for us that we want to investors to judge us by is our market position and how we're going in terms of returns, and that's return on equity, but more importantly for us, which is a similar metric, is return on our tangible equity. And so our new purpose statement about creating better futures together is really about putting that customer at the center of everything we do, making it far easier for customers to do business with us. We really want to be known for having expert solutions, and we're a leader in a lot of areas of that, whether it be in climate and related solutions, or our advice that we have for our markets and economics business, etc. And we really want to advocate for change in some of those key areas that we're looking for going forward. I'll keep moving because I know we're running fairly short on time. One of the key areas we've been investing in terms of supporting those customers and having a far easier and easier to deal with and much better customer experience is the investments we've made in our app. We're a little bit behind the 8 ball in that. We've been a fast follower, and we think we've got all the functionality now to be market leaders. Probably not quite there in terms of the ease of navigability around our apps, but we've made really good progress on that, and our net promoter scores have been reflected in that, where we're getting really good customer feedback and customer traction on that, and we think that'll lead to a much better experience. That's pretty well advanced. We've made really good progress on our mortgage origination systems, so we're getting a much better experience now in terms of time to write, as we call it, through our mortgage origination process. So 2 main channels there, the proprietary channel through our bankers and our branches, and then the broker channel. So we've really fixed up to date and seeing much better performance through our proprietary channel for mortgages, which is clearly our main product. With our broker channel, we've still got a bit more work to do. So our one banking platform, which is how all our mortgages are originated, has now been rolled out to all customer segments. And that was really only fully up and running for our broker channel in the last couple of months of the first half. We had a few teething issues as we went through that, but we are seeing improved performance for that broker channel. And we think as we go forward over the next couple of months, we'll continue to see some improvement. And that means we think we'll be in a much better position to grow it roughly at mortgage system in the Australian market. In terms of looking forward and some of the considerations for the second half of this year and then into FY24, while we had a really strong half year, there are some margin headwinds. And so the tailwinds we've seen from higher rates and the benefit that's flown through to our deposit book have effectively run their course. And we've still got some competition flowing through on the lending margins. So in that environment, we're likely to see some headwinds on our net interest margin as we move forward. System credit growth is easing, but we've probably seen a bit of an inflection point in the last couple of months, both here and then more recently over in New Zealand, where house prices have looked like they've bottomed for the time being, and system credit growth, certainly in the mortgage space, feels like it's bottomed. We're looking to grow share in business lending, in particular at the larger end of town in our institutional bank. And finally, from a revenue perspective, given those business sales and the simplification we went through, we'll have a full year impact of some of those business sales. On the expense side, we've seen pretty good cost discipline from us over the last couple of years, and it has been a differentiator vis-a-vis the market, but it's getting harder. So we're seeing more underlying inflationary pressures flow through. And some good examples of that are in our supplier base, whether it's our cloud computing suppliers, whether it's our mainframe for our core banking systems, our outsourced providers. So we're seeing quite a bit of underlying inflationary pressure from our key suppliers. And on the wage front, a little bit of upward pressure, not too bad. And then we've still got quite a large risk and regulatory program, which is still fairly costly. So we've got a cost reset program overlaying all that to try and keep a lid on costs as they come through. But costs are certainly a headwind for both us and the sector probably for the next 12 to 18 months. On credit quality, it's pretty benign. We're not seeing too much, both here and across in New Zealand. So if you think for us, New Zealand's a fairly small part of our business, about 10% of our earnings. We're seeing a few signs in the business book over there in agriculture, not surprisingly, partly related to the storms and and flooding. Back in Australia, we're seeing a little bit of stress in corporate books, but not so much. Not surprisingly, it's in the construction space and the property space. We're seeing a little bit of that in New Zealand as well. For mortgages, it's pretty benign. So a very modest uptick in our key metric, which is 90-day arrears, both in New Zealand and here in Australia. And given that environment, as I mentioned earlier, we want to maintain a fairly conservative balance sheet and balance sheet settings as we move in. So I might pause there. In terms of the priorities and outlook, I've sort of touched on most of those during the presentation, and given I'm cognizant of time, Oliver, I might pause there to see if there's any questions.
Yeah, great. Thanks, Justin. That's perfect. And yeah, a few questions that have come through. Largely touching on some of the topics that you've spoken about. One, sort of maybe starting at a very high level. You spoke there about sort of NIM compression, which I think's been spoken about recently, and over sort of the last maybe 1 to 2 decades, and across the New Zealand and Australian banking sector, that kind of NIM compressions happen at the same time when capital ratios are increasing. So over on this slide, the Reserve Bank's obviously putting in increased capital requirements over a period of time, and I understand the same sort of things happen in Australia. Can you kind of comment just at a very high level how all of those sorts of factors play out together, and maybe also in the context of, you know, the bank being able to maintain a fairly strong ROE throughout those kind of headwinds, I suppose?
Yeah, so clearly we're holding a lot more capital than we used to, and we have seen NIM compression over a long period of time, and so returns have come down over a period of time. We suspect on a medium-term view that continued downward trend shouldn't occur, and that ourselves and the rest of the industry should be able to earn above cost of capital returns. So for us, on a medium-term view, we think a return on tangible equity in the range of 13 to 14% seems appropriate and reasonable based on what we can see. The upside of holding higher capital levels means that the ticket to entry and the ticket to the game is actually quite high, and related to the, you know, significantly regulatory impost means that additional competition is hard. So the existing players compete pretty hard, compete very hard together, but for new entrants to come in, it's pretty difficult. So we think, given that industry structure, that where we are now, unless we see regulators want us to hold a significant more amount of capital than we currently are, and we think that's unlikely given, you know, the 4 Australian majors are all effectively the top 10 in terms of global capital levels when you adjust it for international comparable type levels, that it feels about right. The next 12 to 18 months will be a little bit different because we've got near-term margin headwinds, but we think that's more of a near-term issue. And then clearly we've got some uncertainty on the credit quality side, where we're seeing a bit of deterioration. The lags are longer this time, and it's interesting that Australia seems to be going through more of a New Zealand cycle on the mortgage book, where a much larger part of our mortgage book this cycle is in fixed rate loans, not variable rate loans. So for example, on our estimates, you know, the effective mortgage rate in New Zealand is in the low 4s, despite you know, the RBNZ cash rate at 5.5%. So clearly the effective mortgage rate as customers roll off those fixed rate loans over the, you know, starting now, will push quite a bit higher, and that's why we see that growth outlook's pretty anemic, both here and across in New Zealand. So our best guess in terms of our economic forecasts are that effectively for the next 4 to 6 quarters, you're not going to see much economic growth at all in either Australia or New Zealand. We'll sort of bump along the bottom. So notwithstanding those near-term issues, we think, given the industry structure and where we are on capital and the outlook, that return in that 13 to 14% range from a return on tangible equity should be achievable.
Right. Yeah, no, thanks very much. And I suppose that aligns with what you're saying around some of those interest rate sensitive industries starting to see a little bit of a pickup, and some of the stress you know, thinking about trades and property and construction, etc. So I suppose there's maybe some more of that to flush through the system. Just in the interest of time, we'll probably have to keep moving, but we will send through any other questions that come through to you, Justin. But thanks very much for your time, and yeah, thanks for coming along today.
Pleasure, and happy to answer them, and thanks for the opportunity.
Great. Next up, we've got Dr. Hartley Atkinson and Malcolm Tubby. They're coming to us from the North Shore, from AFT Pharmaceuticals. Hartley is a co-founder and currently the managing director of AFT, and Malcolm's been with the company for a long time as well, and is currently CFO. So we'll be introducing them in shortly to give us an update on where they're at in the AFT space. We're just going to wait for them to join us. AFT's had a strong year this year. Record for them of about 157 million, and they're starting to expand offshore significantly into sort of the Chinese market and also around North America and Canada and the US. So a lot of interesting things happening and a big growth. So I think we will hand over now to, we've got you. Thanks, Hartley.
Good, thanks a lot. So look, just to go through the presentation, thanks everyone for attending. So first of all, we've got the standard disclaimer, and then look, just to move to the next slide, number 3, to kind of give you an overview of where we're at. So look, we made good progress along the things that we said we'd do. We paid our maiden dividend just recently, and we did have a record revenue. I mean, if you just look at that bottom left chart, I mean, really this is what we've been working on. Revenue's roughly quadrupled or slightly under quadrupled over 10 years. You know, our whole push and aim is certainly not to slow down, and this is what we're kind of working hard on. What I mean maybe has been a bit challenging is we do tend to have some lumpy licensing income. So if you look at that bottom graph on the right, that has caused maybe some confusion over the last few years, and we've been careful now to split it out so it's much clearer, the difference between our sort of business as usual income, which is from selling pharmaceuticals, and then we also do qualify periodically for certain licensing payments like upfronts or milestones, and they can be lumpy. You can see, for example, one of them 2 years ago was 6.7 million, you know, so just really making clear to split that out. But really, we floated and we raised money in order to accelerate our R&D. We said to our investors we were going to lose money in the first sort of 2 or 3 years, which we did, but you know, we've moved into profit, and now the aim really is pushing on and building the business. So look at the next slide, please, Malcolm. Look, yeah, this just sort of also shows you the progress. The key things you can see: Australia, New Zealand, we had really good growth. The area that we are making and working really hard on, and I guess as an investor to watch closely over this coming year, is our progress in the other areas like Asia and rest of the world. We believe we're making really good progress, and then that should start to show in the sales results. I mean, to be frank, what we did see happen was COVID did really restrict and slow down a lot of our international efforts over the last sort of 2 or 3 years, and we're now really seeing that receding quite rapidly as pretty much the whole world, especially Europe, has very much opened up and COVID has receded. So that's really the sort of push that we've got on there. But you know, we've got some good growth in actual sales. Once again, I just mentioned that licensing income. If you look at international, it looks as though it went backwards, but there was a big chunk of licensing income in the FY22 time period, but actual sales improved 71% last year, which was a good result. And then also we're getting strong revenue growth from our Australasian business, which is Australia and New Zealand. And then just looking quickly at this, you can see Australia grew by just under 23%, and we're getting really good performance in our OTC channel. We see the OTC channel as a nice area to be in. One of the reasons is that, you know, as we know, everyone's talking about inflation and inflationary pressure. Certainly having a good chunk of your business in the OTC area gives you a lot of flexibility, because it is easier to change and adapt pricing going forward. So that's always why we're keen on a good chunk of our business being in the OTC area. So the next one, Malcolm, New Zealand. Look, just quickly to show you there, you know, getting good progress in the New Zealand market. I mean, we always work quite strongly off a strategic plan, which we do literally this month, and we're in the middle of doing ours now. I mean, a few years ago, we thought New Zealand might sort of level out about 42 mil or something like that, but to be frank, we were wrong, and we really see some good ongoing growth prospects in the NZ market. So, you know, we've got a lot of things we're working on to push and accelerate our sales in our local home market. Malcolm, next slide, please. And look, part of this is what happened, especially during the COVID period when we couldn't travel. We actually did a lot of in-licensing, and this work is still continuing. Literally in our local markets, over the next 3 years, including this year, we've got some 68 new product launches in the Australian and New Zealand market. Last year, you know, we had a good number of launches, about 22 launches. And certainly our growth that we're seeing going forward in our local market is driven by existing organic growth, but it's also certainly helped and augmented and accelerated by growth from these new products. This does often take a while to kick in, but, you know, over a sort of time period, 2, 3, 4, 5 years, the new products are pretty significant in helping the business grow. Next slide, please, Malcolm. Asia is a key focus, and, you know, as I said, you know, have a good close look at how our actual sales results progress this year. We have been working hard on it and seeing, you know, starting to see the fruits of some of that work. We're certainly making some good progress in our OTC channel in markets like Singapore and Hong Kong and Malaysia, but also starting to do a lot more work on China. We have got our Tmall site is up and going. We are bringing that in-house, where that will leverage and give us greater sales, but we also see we can get better sales as well by being able to focus ourselves on, you know, the promotions. And one of the key targets as well is also looking at licensing into China, and that basically is a work in progress, but we would hope to be making some announcements around that this financial year. So certainly Asia is a big push, and yeah, we've seen some really good results in some of our markets like South Korea. We've been very pleased with our progress since our first launch in that market. So international, this is basically everywhere outside Australia, New Zealand and Asia. As I mentioned before, we grew, excluding licensing income, we grew sales by 71%. And yeah, really going forward, this is a key focus to grow these everyday sales as we accelerate product sales in the markets where we've launched, and then also to increase our number of countries launched as well. Maxigesic rapid tablets are now approved in the United States, and we are under a number of discussions around getting this product to market in the US. Also, another key thing we've been working on is we have a UK company and a UK hub to help us drive growth in the UK market, and also to help run Europe, which is becoming more significant over time. A lot of our business presently is quite Europe focused, and we have about 3 or 4 launches we're working on presently in the UK. And I mean, clearly the UK has a population of about 67 million, so it's over twice the size of Australia and NZ. So it makes sense that it is a good market. The point also that's important is that with the UK dropping out of Europe, then that actually has given opportunities, because in the past it sat very much in line with the rest of Europe. It was all part of European drug deals, etc., but now it doesn't fit. So actually it fits in quite well for a lot of people that are doing drug development. It fits in quite well actually with Australia and NZ. So this has given us a number of opportunities, and we're also launching some of our own products ourselves, like Maxigesic IV. We're going to launch that ourselves, and also Maxigesic as a general sales medicine. We're launching that ourselves as well. And then Clear as well, another key thing is the IV launch in the United States. We have a PDUFA date of October. The requested data has gone into FDA, and we're waiting on some progress with that. Obviously, we can't guarantee it, but our partner Hikma is very experienced in this area, and they helped us do some of the additional work the FDA wanted. It's literally around something called extractable and leachables, which is just what leaches out of the glass and the rubber bung. And we've done all that, and Hikma was certainly very happy with it, which we took as a positive sign. So we're waiting on that October PDUFA date. Next slide, please, Malcolm. Yeah, look, this sort of graph just gives you a bit of, it's not graph, global map, gives you a bit of an idea of, some of our progress, what we're working on. So the areas in yellow is where we've launched products and rolled out product launches. That's gradually getting larger over time. Blue is where we have licensing agreements but have not yet launched. I guess it's important to point out a big chunk of some of it is Russia, which we've currently parked, I guess due to obvious reasons with the current conflict. And then in white, where we've not yet done a deal, the main chunk of that is China. As I said, we're working on that and making progress. Another key area is Brazil, which is quite a difficult territory, and we are having discussions with 3 or 4 parties around progress in terms of licensing. Japan is the other area, which is also quite particular and specific, so we are doing some work in Japan as well. India is sitting there in white. We're actually not really targeting that area. It's not something that we want to target, so that won't ever really get filled in. And the other big one is that white in Asia, which is Philippines. We have products in approval, and once we have them registered, we'll sort out a distributor, but nothing's sorted out yet. Next slide, please, Malcolm. Yeah, look, this is just to give you an idea. I mean, almost it's a fallacy that a lot of people think we're just a Maxigesic company. We're certainly actually much broader than that. We've got a strengthened and growing R&D pipeline, which has global potential, which we can then add to our sales, which are starting at the moment with Maxigesic, but over time, the rest of this is really going to start to drive things. What is good at the moment is, economic conditions generally in some of the big markets like the US and Europe are actually pretty grim for smaller drug development companies. They can't raise funds. I'll give you an example. The other day, there was a company in Singapore which had raised over 200 million US, and they literally closed down because they couldn't raise any more capital because they were loss making. Our advantage is we can do in licensing deals with some of these parties which are under pressure. for very good financial terms. And effectively, what we do is we don't buy them. There's no point. We in-license the technology. We develop it under our clinical R&D program. We spend 12 million, maybe we'll go up to 15 or so million a year on R&D. And then the parties that own the original IP will, qualify for some of that. We have agreements in terms of a profit share sort of thing, which is, we believe, pretty favourable to us. And that's really what's kind of happening to pad out this R&D pipeline. And we're also looking at another couple of projects as well, so we'd hope to have some further announcements this year. But yeah, this really is a key area, and it's the sort of thing that big pharma don't do, because it isn't like a multi-billion-dollar new cancer treatment, but it's still a very needed and globally has significant sales potential. Just some examples, for instance, is the antibiotic eye drops. So that is for drug-resistant eye infections, where otherwise people could go blind. So that's a pretty important therapeutic intervention, obviously. Strawberry birthmarks is another one. We licensed technology off Massey University here in New Zealand, and that's actually a very nice product that we're working on at the moment for strawberry birthmarks. A lot of infants, quite a significant number actually, are born with strawberry birthmarks on them. Presently, they usually don't do anything about it. You can surgically excise them, which would result in scars, or they have an oral treatment which they use only in very serious cases, and it's actually quite toxic, so they reserve it for certain serious cases. But with our treatment, it's topical, and we believe it could be used in basically any strawberry birthmark, and that's certainly something we believe is worthwhile. Doctors tell us it's something that is important, so that's an example, some of the projects we're working on. Next slide, please, Malcolm. Yeah, look, just to kind of sum up and kind of give you an overview of where we're at in this FY24 financial year. We're pushing really hard to grow the business. We got reasonable growth last year in terms of sales growth. If you ignore licensing income, we grew sales by 26%. And as I said, over the last 10 years, we've almost quadrupled sales. So we're not, looking to slow down. So we are growing our existing portfolio. We've got this aggressive program for new product launches as well in our key Australasian markets. Also too, though, we are, really also working extra hard on the international Asia side, which are obviously large markets. We're always restricted somewhat in Australasia by our population, which even, we talk about Australia, but Australia's still only 26 million people. And then we're looking at expanding very much our UK presence, which has a good population, 67 million. And there is a good opportunity now. We've seen Brexit, that improves that market opportunity. Also, we're accelerating our e-commerce platform. So we've launched Amazon in North America. So really targeted at this stage in our liposomal vitamin category that we sell in New Zealand. We've recently launched in Australia as well, and also launched in Singapore and Hong Kong. And then further building Tmall in China, and then also Amazon in Australia as well. So this is all part of our general offering. As I was saying, a key part of our business is this R&D pipeline, and we're targeting increased, acquisitions in this area, and we see them, as very attractive. Almost, in my experience, I've been in pharma over 30 years, and I reckon it's a once-in-a-lifetime opportunity. So, we're working pretty hard on this, and we'll be hopeful to make some further announcements. Having said that, it's really important to note what we're doing is we're funding that R&D out of existing profits. So we're really making profits. Our profits are growing. So not looking to raise capital to go buy things. We just acquire the rights and we use our profits to expand our R&D. So a lot of times I think people are not really looked at our R&D pipeline, but that is, in my opinion, one of the key value drivers of our whole business. Operating profit guidance, 22 to 24 mil. Look, it's important to note though, this excludes one-off kind of licensing income. So there is about 6 million hanging around on the launch of Maxigesic IV in the United States. We would hope and plan for it to be this financial year, but you know, if there was for some reason some delay, it could end up being April, just outside the financial year. So would, you know, not be booked this year, but overall big picture, it wouldn't be a disaster. It would just be a matter of timing. So the guidance as well is subject to the US Maxigesic rapid commercialization strategy, which we're presently working on. So that could be a sort of factor that could have implications. And then also we are working on targeting, you know, 200 million of annual revenue. Yeah, we're not saying it's exactly this financial year, but certainly it's in the next kind of 12 to 15 month kind of time window. Yeah, that's really what we're working and driving on, pushing those sales. So look, hopefully that's a bit of an overview of what we're doing with our business, and happy to try and answer any questions that people may have. Thank you.
Great, thanks Hartley, and thanks Malcolm. Just in the interest of time, we might only have time for one question, but I think shareholders will be interested to know, I think you've declared your maiden dividend and obviously spoken about the importance of continuing to invest in R&D. So could you maybe just elaborate on sort of capital distributions or capital structure decisions that you're going to have going forward in policy around dividends versus reinvesting in growth versus, you know, maybe debt reduction, etc.?
Yeah, I mean, Malcolm can comment on some of these details, but just a general overview is we're sort of looking at a distribution normally once we get our EBIT to borrowings at a kind of rate of about 1. You know, we're sort of looking at paying out about 20 to 30%, probably more the lower end, to be honest. The reason why is we still want to retain capital to really grow the business. So that's our sort of, you know, thinking. We do see ourselves as still more of a growth stock, but also growth stock that's making money, and we're paying a dividend at the same time. So, I mean, that's our thinking. Malcolm, do you want to add something?
No, I think you've covered it all on there. So yeah, the target's 1 times EBITDA net debt. But I mean, there's a bit of flexibility in that. The facility, we can go beyond that with the facility if we needed to.
Right. Great. No, thanks very much. Very insightful, and great to hear things going well. So thanks very much for your time, Hartley and Malcolm.
Great. Thank you, everyone. Thank you. Bye.
Great. So next we've got Argosy Property, and we'll be joined by Peter Mintz. Peter is the current CEO. He's been CEO there since 2009, and he's got 40 years of experience across the industry. So a very detailed and broad history in the property space. So we'll welcome Peter and now to present on Argosy.
Good morning, and thanks for sharing the time with us this morning. I've got for you a reduced version of the presentation that we've recently been giving around the country to our retail investors. So a bit of a quick prosy. One slide on vision and strategy. What is the business? What is Argosy at a glance? A bit of a summary of the portfolio and what we're seeing in the 3 main sectors in which we're active, and what we expect to see over the next 12 months. So just firstly, what is Argosy? How do we fit together? Obviously a listed property company. It is about being diversified by sector, diversified by location and by tenant mix. And as such, that gives us a natural attraction to the domestic retail investor. It is also about being green. And whether you believe in man-made climate change or not, the net reality is that over 80% of our lease inquiry is specifically for green buildings. We've been working pretty hard in this space over the last 15 years, and around 31% of the portfolio now sitting in green buildings. So we've got quite a bit of progress, targeting to get that over 50% in the next round. So there's quite a bit of work going on in that space. And it's probably fair to say that over the last 15 years, been very focused on what we're doing about climate change, but we're also seeing increased focus on what is it doing to us, and reporting over the next cycle, you'll see some of that coming through, making sure that there are no stranded assets and that investors are aware of the costs involved, and making sure that the properties are resilient. It is pleasing to note that with the big rains and weather issues we've had over the last 12 months, the work that we've done thus far meant that we had no problems in the portfolio. As a result, we're looking at being a very resilient business, and what this is really about is making sure that we don't have to take action that we don't want to take. We don't want to sell assets that we're not ready to sell. We don't want to be raising equity when we're trading at a discount, and we certainly don't want to be reducing the dividend. One of the things that we've seen over the last 12 months in the resilience and green space is an increased focus by incoming tenants on embodied carbon. And specifically, we're starting to get inquiry from offshore tenants, in particular offshore corporates who do not want to go to a new building. They certainly want an upgraded building. They want a Green Star building, but they do not want us to be constructing new buildings for them. And that's that focus on embodied carbon. Much the same way as your motor vehicle. You know, the reality is for most people, the most climate friendly car they can drive is the one they already own, due to the carbon footprint of disposing of and building a new vehicle. So the big strategic goals over the next few years, we only like dividends going one way, so we do want to see the dividend grow over the next 5 years. We want to see 50% of the portfolio in green assets by 2033, and we've got a strong target on reducing our carbon emissions by 2033 by 30%. So there's quite a bit of work going on there. For us, we've been focused on the green space, say, for 15 years. It is good for the environment and for the occupants. It has been shown for us to stack up from a financial perspective, and the biggest driver of that is simply this is what tenants are wanting now. Over the last 15 years, we've changed from needing to focus on telling people why they should be in green space to showing them how to improve their own carbon footprint. And we spend a lot of time working with our major tenants to enable them to move into a greener space as they grow forward. And it is about tenant demand, but you know, we have a responsibility to the market and to our tenants, because we're dealing with this sort of thing all the time, and they're only making an occupation decision once in every 6 or 10 years. So it is something that we have to work with. Government have come through and said that they only want to be in green buildings going forward, and that has given us some strength, meaning that in our Wellington office portfolio, we're very focused on providing green buildings in the government sector. Most of our rental out of the Wellington sector is in fact from the government. In any property portfolio, you have to be focused on what the risks are to capital, the risks are to stranded assets, and the risk obviously as it runs through into the distribution from the income levels across the building. We've been quite fortunate in being able to show some recent data out of MSCI that shows that the Argosy property portfolio on a bottom-up basis, so taking income and capital into account, has outperformed the index over the current year but also over 3, 5, 10 and 20 years. So as a property investment, that kind of works. Just looking at some of those sustainability credentials, and I won't spend a lot of time in here. There's 14 buildings across the portfolio, and that basically gives us about 36% of all 5-star green buildings by number in the country. We've just received certification of a 6-star rating on the new building that we did for statistics in Wellington. Now that was a building, there's some data on it in the appendix. That was a building that was initially built in the 70s. We expanded it, upgraded it, and refitted it for the tenant for statistics for a new 15-year lease. So just looking at what the business is, listed on the stock exchange in 2002, 31st by market capitalisation on the NZX, makes us one of the larger commercial landlords in New Zealand and one of the few that is genuinely diversified. So we're diversified, as I mentioned earlier on, by commercial offices, by industrial and by large format retail. Recognised leader and one of the first movers in the green building space, and we've been very clear on what the strategy is in terms of building a better future, what we're trying to achieve and what we're delivering. This slide shows the MSCI data that I mentioned earlier on, and there's a couple of things out of there. I've already mentioned the outperformance, so the yellow dots and the yellow line, that's Argosy versus the green dots and the green line, which is the MSCI index. Now, Argosy is also included in the index. But two things to draw out of it. Firstly, the outperformance relative to the index, and second, the lower volatility during that period. So pretty pleased with those results and how they're looking. And if you drop down to the next level on this data, you see that it's outperformance based on asset allocation, and it's outperformance also based on stock selection. They take it down to an individual property level, and from a management perspective, we're pretty happy to see that the performance is very broad-based across the vast majority of the portfolio. And indeed, those that have underperformed are assets where we're under redevelopment, so we're not getting any income out of them, or they're assets that are already on our sale list. So a bit of a potted history and what we're expecting to see over the years ahead. The industrial sector, that's the vast majority of our portfolio. So the biggest sector for us is industrial and in the Auckland market. We're seeing very strong growth there. You see the occupancy in that sector is at 100%, and generally that is what the sector's showing. There's only just a little over 7,000 metres that's vacant in the industrial market in Auckland, right across the market. So very little vacancy, quite a bit of demand, and we're seeing some reshoring, as we'd call it, in that sector, bringing industrial and manufacturing back into the New Zealand market. There's a couple of reasons for that. One, it's relatively not quite as expensive as some other locations, but equally we're seeing an increase in the focus on the carbon footprint of delivery. So it makes it more efficient to be able to manufacture in New Zealand from a carbon delivery perspective. And of course, the quality of the energy that you're using within those buildings relatively better than many other jurisdictions. In the office sector, majority of our work here is with green buildings, and as I said, most of the demand is for green buildings. So this is very much a strong piece of work coming through. And if there's a risk to our current projections here, it's that this trend of working from home is potentially overstated. What we're seeing is increasing activity back into the commercial office space in the city. And there's a lot of contrary data out there in the market. But I think the general trend is that genuine working from home full time is a little on the overstated side. And certainly our buildings are showing themselves in commercial offices to be in excess of 75% full at the present. So those two sectors still looking relatively positive, especially the industrial sector. Where we do see challenges is in large format retail, and retail in Auckland in particular, in terms of the economy, what we're seeing, what we expect to see going ahead, particularly in Auckland retail, where we've got the majority of the pain from interest rate rises and quite a bit of space in the market. We're fortunate in that the majority of our exposure in large format retail is with the Albany Mega Centre, and that is benefiting from a trend across the retail where retailers are looking for fewer but better located premises across the city, and indeed current activity suggests that we're able to get better rentals out of space that's actually vacant than we can achieve out of a market rent review within the centre. So we have no vacancy sitting in there. We're still getting some really good rental growth out of that location, but the sector in general, we still expect to see some challenges going forward. So a bit of a quick history on what we've been delivering. Occupancy's been really strong for the last 5 years, and the weighted average lease term across the portfolio, again, really strong across the last 5 years. With the weighted average lease term, you'll note that in retail, that's somewhat shorter. So we've got some deals to be done over at the Albany Mega Centre on the way through. So we would expect that average lease term in retail to improve as those deals are done. But again, as I mentioned, we're achieving better rentals out of vacant space. So this is a bit of a positive for us in that space. NTA, tangible assets per share, declined over the last 12 months, and that's principally due to interest rates. It's worth just pointing out that this recession is somewhat different to some of the others that I've worked through, in that we've got growing rentals and reasonably good net absorption figures, where we're seeing capital declines based on cap rate softening. So in other recessions, we've seen vacancy going up and rentals coming down at the same time as cap rates were softening, and therefore this time around we're seeing rental growth offsetting to some degree some of those value declines. And the question generally is, okay, so what about values going forward? There's still quite some time before we come up to valuations at 30 September. There are some positive signs in the market, particularly recently with assets in that $20 million price bracket. And there seems to be some increased depth in the market over what we've seen over the last 12 months. So a bit of a challenge, but looking better than it has done. Debt to total assets, we're sitting in the middle of our target range, that's 30 to 40%. And that's courtesy of the devaluation mid-year, up from 31.1, but obviously quite a bit of headroom there, and sitting some distance away from the bank covenant at 50%. So over the next 12 months, obviously we expect to see some continuing challenges in the domestic economy. The inflation figures were halfway between what the Reserve Bank was looking for and what the market was expecting. So probably not much of a change there. But for us, it is about making sure that we're not forced into taking action we'd prefer not to take. It is about making sure that we don't have to sell assets that we don't wish to sell. It is about making sure that we're not raising equity when we're trading at a discount, and it is about making sure that the dividend only goes up. So in order to achieve that, it is important that we make sure the buildings stay full, that we have a really good tenancy mix across the portfolio, and that our diversification remains a strength to ensure that we're delivering on those dividends. Empty buildings don't earn dividends, so we want to make sure that we keep the portfolio full, that we're working to provide the sort of space that enables our tenants to grow in the future, and to make sure that we're not dealing with stranded assets. Realistically, as I think you've probably picked up, the property market fundamentals on a bottom-up basis still remain relatively strong and stable. We are looking at continuing net absorption figures that are positive. We are continuing to deliver some steady rental growth. Expect that to continue everywhere, with the possible exception of the retail space. We're seeing a strong rising demand in the market for green buildings, and that's well positioned for us. And obviously, sustainable dividends, my retirement relies on it as well. I've got some other stuff sitting through in the appendices, which you'll be able to pick up, but I'm happy to take any questions from there.
Thanks, Peter. We do have a couple of questions that have just come through. First one's just around, you've sort of touched a lot on the sustainable side of things and the green buildings, etc., and sort of obviously being a market leader in that space. Have you seen anything in terms of that translating through to maybe being a bit of a pull down on cap rates rising? You know, is it that in that space, investors or property values are sort of propped up a little bit in that space compared to the wider market, in particular probably office in there?
Yeah, look, I think that's a really good question, and it's not just in the office space. We're also seeing it in the industrial space. So, I mean, the symptoms and what we get on the receiving end, you get less vacancy, you get higher rentals and higher tenant satisfaction across your portfolio. It does mean that you've got a better fundamental investment, and as a result of those, your cap rates are remaining firmer. And the biggest driver is the tenant demand, and we're fortunate with the portfolio and being able to look at very much comparable assets in similar locations and say, well, what is the difference between a green and a non-green asset? So it's certainly stacking up for us from that perspective, and I expect that to continue. I think that there is a logic in the future of saying that if you don't have a green building, then you are at risk of a stranded asset.
Yeah, agreed. And do you see the same sort of trend in, you've obviously RC's got 3 listed green debt instruments. Is there an observation that you have in that space in terms of maybe spreads being a little bit tighter with that green element in there?
Yeah, look, I think that's another good question. So there's 3 green bonds out there in the market, and the first one, we don't think we got a pricing advantage at all. The second one, we didn't think we got a pricing advantage, but we certainly got a volume advantage. And the third one, the market was starting to get a bit more mature and understand what was happening a little bit better, and we believe we got both a pricing and a volume advantage out of that third one. So I think as we move forward, we'll see that increase. For us, there was still some solid reasons for doing that, even if there wasn't a pricing advantage, because there's a great deal of benefit for us from delivering the congruity between the way that we fund the business and the way we run the business. So we felt that was valuable in any event. Great.
Perfect. Oh, thanks very much, Peter. We better keep moving just in the interest of time, but thank you very much for your time and presenting, and yeah, all the best.
Thank you very much. My pleasure. Cheers.
And lastly, now we've got Jeremy Nicol, who is going to be joining us from Arvida Group. Jeremy's just joined us here. So Jeremy's been CEO at Arvida and Arvida obviously operate in the retirement space, but also a bit of aged care mixed in there as well. So Jeremy, I'll hand over to you and be back shortly.
Good morning. How are you? So thanks for taking the time to have a listen about a little bit about the Arvida story. We are a national business with around 36 communities that are up and running. We have probably just under 7,000 older New Zealanders that live with us, and we do that through a combination of your traditional retirement village living. So we've got just over 4,000 retirement village units, and we also run rest homes and hospitals, and we've got about 1,500 care beds through the portfolio. Our business is really underpinned by a very strong aging demographic. As you can see from the chart on the screen, at current levels, we're sort of just under 400,000 people over the age of 75. When you fast forward to 2047, so that's 25, 24 years away, that group will double in size. So we'll be getting up to around that 800,000 level. So what that means is there's a strong, growing target market for retirement village and aged care products. And what we've seen through the last 3 years of the COVID pandemic is that older New Zealanders really value the benefits of the social environment, the safety and security that retirement villages provide, and also the benefits to well-being. Currently at the moment, of those people aged over 75, about 14% of them live within a retirement village. So obviously if that penetration rate continues, we'll need to build, twice as many retirement villages over that next 25-year period. We've obviously just been working through our year-end process to 31 March 2023. It was pretty tough operating environment. When you go back just over a year ago, we were battling COVID throughout the country, and that caused us, we spent more money looking after our people, both our residents and our team members. And we also had the situation where there were border restrictions, and so staff shortages were also an issue. We've also seen that the residential property market has had its peaks and troughs over the last 12 months, but seems to be coming right. In terms of our key metric, which is the underlying profit, for FY23, we were up 20% to $88 million. And we also saw a strong increase in our annuity EBITDA, which was up 30% to $84 million. In terms of the accounting net profit after tax number at 82 mil, that was down 59% on the prior period, and that was really as a result of a lesser increase in the fair value movement of our investment property. In terms of our operating cash flows, we generated just over $150 million from operating activities. When you look at our balance sheet, we have $3.8 billion worth of assets in the country, and the vast majority of those are represented by the retirement village side of the business. Over the year, we saw that number increase by about 400 mil. That was up on all the development activity that we're undertaking at the moment, and also the increase in the fair value of our assets. We look at embedded value quite closely, and for those that don't know what that means, the embedded value represents the cash that would be generated if all of our retirement village units turned over today. So that means we've realised the cash from gains on increases in the value of the units, and would also realise the cash from the deferred management fees that we charge to live within our retirement village units. So embedded value at the moment is $1.1 billion, and that represents $1.56 per share. Based on current trading at about $1.25, we're trading at a 20% discount to the embedded value of the portfolio. When we look at our net tangible assets at $1.90, we're trading at about a 35% discount to that NTA. At year end, gearing was 31%, which is within our 25 to 35% range, and interest cover was at 2.7 times. Yeah, we do spend a lot of time investing with our team members. We have just under 3,000 employees within the group. The vast majority of those are working within our care centres. So we'd have about half of our workforce would be caregivers. We employ about 250 registered nurses, And what we've seen over the period is that our staff engagement has lifted from 7.2 out of 10 to 7.5. And we are comparing ourselves against a global peer benchmark at 7.8. So some good momentum there as we spend more time investing in our employee brand and refreshing what it means to work at Avita. In terms of our residents, how we've dealt with COVID has been the key component over the last few years, but we now moved into a more normalized position with the pandemic largely behind us. Every year we do a Net Promoter Score survey independently of our residents. So obviously the scores for Net Promoters go from -100 to +100. So we're very, very thrilled to get a +38 from our independent residents and a really outstanding +59 from our care residents. And that care residents number really illustrates how well we did look after our residents through the pandemic. We've also won a number of awards, whether it's the CanStar Most Satisfied Customers in the retirement category, and our villages are also winning awards for how we lead sustainability within some of our sites. We do have some reviews coming up. The Retirement Village Act is now 20 years old, and so there will be some reviews of those over the coming years to look at modernising the requirements within that Act. Sustainability is a key strategy for us, and we've done a lot of work engaging with our business on targets and ways that we can do things better. The key target for us this year was about diversion of waste from landfill. We partnered with the University of Otago with a pilot on food waste, and that's seen some very good reductions in the amount of food that has been wasted, but also that goes straight to the bottom line as a benefit as well. We do include within all of our reporting Scope 3 emissions, and we also have our sustainability work audited independently by Ernst & Young. In terms of governance, we have really been focusing on how we ensure that we deliver health outcomes equitably between all older New Zealanders, so working very hard on our Maori health policies and also for Pacifica people as well. About a year ago, the new standard for health and disability Ngā Puera was introduced, and that has higher levels of governance required. So we're really focusing in on how we deliver care and making sure we're doing it in the right way. In terms of our development business, last year we delivered 215 units in the year. We had a target of exceeding 250, but we missed that with the delays with one project in Browns Bay of Auckland. That project was delayed due to weather events and is now completing this week. So that's going to be exciting to have that building handed over, 60 brand new apartments in Browns Bay. We also opened Lauriston Park, and I'll talk a bit about that in a second. This year in FY24, we're looking at delivering around about the same number, so around just over 200 units. And we're continuing to increase our land bank, which is up to 2,200 units presently. So Lauriston Park Care Centre is in the bottom right of the building, the H-shaped building. So we opened this at the start of June. It has 63 purpose-built care suites in it, and those rooms range from a size of 35 square metres up to 55 square metres, and people can receive rest home level care or hospital level care or dementia care on site there. That has been selling particularly well, with just over 20 contracts signed, another 10 pending. So within a month and a half, we're nearly halfway through the sell down of that building. As you can see in the picture, We also have a further 200 villas on site, so a large catchment for the care centre as well as the surrounding Cambridge community. So as I said before, this year we'll be targeting just over 200 units. We've only got one multi-storey building in the program for this year, which is pictured on the right, which is the Aria Bay and Browns Bay project that I was just talking about. So that's got 57 apartments, and the balance of the delivery is villa-led, and obviously going from Kerikeri in the far north to Queenstown in the south. We do have another couple of projects that will take a longer period in time. In Queenstown on the right, we're delivering a care suite and apartment complex. They'll have 62 care suites and 29 apartments. We're utilising a cross-laminated timber superstructure for that building, which is now mostly complete. Roof will be next, and then we'll move into fit out. So we're looking to deliver that project early in FY25, so probably just under a year away. And then we've just commenced in Tauranga at our Bethlehem Shores site, another care suites and apartment building. Obviously they're just working on foundations and coming out of the ground there. We have a number of greenfield projects underway at the moment. On the far left, on the left is Te Puna Waiora in Kerikeri. We're building the clubhouse at present, which is the big building in the middle of the picture, and you can see the villas in the background there. On the right is a brand new project for us in Te Awamutu called Whai Moriora, and we're just finishing the first stage of villas there with an expected outcome of probably around 135 villas on site, plus a care centre to come there as well. We've recently just acquired a large piece of land on the northern side of Warkworth, which is there highlighted in yellow. Coming off the bottom of the screen is the new link road that heads out to Matakana. So now you come off the brand new motorway, up the link road, and you turn left if you're going out to Matakana, and our site just also borders the Warkworth golf course there as well. So that's going to be a really exciting project for us. We'll be looking at building about 200 villas on site there, and a care centre with between 30 to 50 care suites on it. So that will be a very exciting project for us. I'll just close up now, and in summary, we are seeing very high levels of demand for our product. We have been providing an outstanding lifestyle for older New Zealanders, and that's coming through in our Net Promoter Scores and some of the awards that we are winning. Our balance sheet is strong at that 31% gearing level, and we have got a very disciplined approach to how we invest our capital, making sure that we're investing into the right projects at the right time. So at that point, I'll just hand it back to Oliver for questions.
Thanks, Jeremy. Yeah, a couple of questions that have come through. One's just about care strategy, and whether you could sort of talk to that a little bit more. I know that recently you and the wider group have spoken about some of the challenges in that space in terms of funding situation, and then how that possibly plays through to development pipelines, etc.
Yep. So what we've just gone through with Te Whatu Ora is a review of pricing for the care that we deliver. So on average, it's roughly around about a 10% increase in care fees that we'll receive from 1 July. So this month, the new fees come into effect. What that does is help us sort of catch up a bit on some of the profitability that's been lost from care delivery, with us being required to pay more to our workers to retain them, particularly in that registered nurse piece where there's a lot of competition for nurses in the country. But what we have seen is that it's very, very challenging to build a traditional care centre with land prices and building prices, and then get an adequate return off that investment. So our strategy in the early days was buying care beds, so we didn't have to build them, we'd buy them at reasonable rates. And now we're moving into building these things called care suites. So a care suite means that we get the usual care fees, but we also charge an entry payment to get access to the care suite, and we also charge a deferred management fee for the use of that unit. So those tools mean that we can generate better levels of return. I think the issue for New Zealand is that we have seen a lot of those traditional care beds starting to close, and the profitability in them hasn't been sufficient to enable operators to reinvest in those facilities. So you will see this Jaws effect of having some really nice premium products, care suites for those that can afford it, and the stock of aged care beds is starting to diminish.
Great, thanks. And there's sort of a follow-up that links roughly into that. There's been a specific question around living wage and whether Arvida pays a living wage across the business. Could you comment on that?
Yep. So we, of our employees, there's probably a group of around 500 that are close to the minimum wage, and they would be less than the living wage. They will generally work within our care centres, and as I just talked about, the funding for our workers within care has been limited. So it's something that we're working hard with Te Whātua Ora to improve. Some of our workers are going through a pay equity claim process at the moment, so that will be happening over the next 6 months. So that will hopefully result in better wages for our workers and a equal and opposite increase in funding rates as well. So yeah, very cognizant of the cost of living at the moment for our workers, and working with the government on how we can get those pay rates higher.
Perfect. Thanks, Jeremy. And one last question is just around sort of a high level, how you would view Arvida as differentiating itself from, say, the other big players, see Oceania, Ryman, Somerset's. What's the sort of point of difference at Arvida?
Yeah, so our point of difference is really about having communities that are differentiated. So we're not all the same in terms of our communities, whether that's built form or the way that we actually deliver care as well. So from a built form perspective, we do look to have a wide range of different types of facilities. So, very high-end facilities in places like Tauranga and in Queenstown, and they generally don't look the same. And with our care provision, what we're trying to do with care is implement an attitude of care that means that it is very much resident-centred and resident-led, and that the person receiving care will determine how they want to receive that. So working with our residents a lot closer on what makes their life better with us.
Perfect. Thanks very much, Jeremy. That's all for now, but thanks for your time and for presenting today, and all the best. And that concludes today's event. So thank you very much for joining, everyone. Just to reaffirm, the recording will be available in the next couple of days online on the NZX YouTube channel. And if there are any further questions that people have, I'm happy to take them. If you just direct those towards the NZX events email address, we'll get those through to the presenters. But thank you very much for joining us today, and we will see you next time. Thanks.